Good morning. I'm Andrea Lowe. We're delighted to see so many of you here today.
Performance is consistently good. Clearly it's cyclical, and there are vintages that perform less well than other vintages, but private equity over the long term has delivered very consistently very strong outperformance relative to public markets.
We still think there's an enormous amount of latent value within these listed private equity vehicles.
I think that's how investors should look at all of the listed private equity stocks is, what do you think the value of this stock will be in the future? What are the value of the assets in the future? And then come up with the appropriate rate, and whether that's a discount, fine.
This is the biggest conference we've ever had. We've had over 200 attendees. I was particularly struck by Emma Osborne of Graphite commenting on our portfolio growth. 13% growth in EBITDA suggests she's got a portfolio of investments which are going up.
What we are seeing is a steady improvement in the environment for realisations, and so we think that that should continue this year.
We don't see listed private equity as more risky than general equities, and we think that in recent years the model has been de-risked quite substantially.
By choice, both sides of our business have gravitated towards listed private equity.
The great thing is, with the listed private equity space as it is today, you've got a choice. You can, there are some very good funds out there that are returning capital to shareholders as income, and if that suits your particular client, for our particular clients, that's very attractive. If you just want to be for capital growth purposes, there are plenty of trusts out there where the income isn't a priority and isn't paid out.
The key thing is that the direct private equity investor has control over the management of his investee companies, rather than an investor who is a passive shareholder in a wide range of bigger companies whose policies he can't influence.
It also, in the context of private equity, is an extraordinary contrast with the degree of knowledge and immersion that the best private equity managers have in the businesses they invest in, relative to the thin layer of knowledge that, in my opinion, most fund managers have of the businesses in which they invest.
There aren't many good active fund managers, that's the reality. In my field of, say, 2,500 unit trusts, I could probably get it down to, or have got it down to less than 5%.
There are far too many funds, but ever since I started in this game 27 years ago, we have talked about consolidation in the industry, but because it's a low capital intensity business, no one ever really pulls out. So we're still debating this 27 years on.
2/3 of growth in value has been through improving profits, and that doesn't just happen by accident. People in private equity do understand the companies, they do spend a lot of time, they hold the companies for years.
I think the kind of vehicles we're talking about today, I very much hope that this will be an increasingly significant part of the investment scene. And it's a way of developing, in the right kind of measure, the role of private equity.